Something unprecedented just happened in the gold market. And I'm not talking about another price spike or some analyst's prediction. I'm talking about a structural breakdown that's been building for months, and it just reached a critical threshold. Let me show you exactly what I mean. Right now, as I'm recording this, gold is trading near all-time highs. But that's not the story. The story is what's happening behind the scenes in the physical gold market. And when you see what I'm about to show you, you'll understand why some of the smartest money managers in the world are calling this a once-in-a-generation opportunity. Here's what's happening. The COMEX, which is the primary exchange where gold futures are traded in the United States, is experiencing something that hasn't happened at this scale in decades. The registered inventory, which is the gold that's actually available for delivery to futures contract holders, has been draining at an alarming rate. Now let me explain why this matters. The COMEX operates on a fractional reserve system. For every ounce of physical gold in their vaults, there are multiple paper claims on that gold through futures contracts. It's similar to how banks operate, where they don't keep all depositors' money in the vault because they assume not everyone will withdraw at once. But what happens when everyone does try to withdraw at once? That's what we're seeing right now in the gold market. Central banks around the world just completed their third consecutive year of purchasing over 1,000 tons of gold. Think about that number for a moment. 1,000 tons. That's not a small amount. That's not diversification. That's a systematic shift away from something and toward gold. The World Gold Council just released their full-year data, and the numbers are staggering. Central banks are buying gold at a pace we haven't seen since the early 1970s, right before the last major gold bull market that took prices from $35 an ounce to over $800. But here's where it gets interesting. These central banks aren't buying paper gold. They're not buying ETFs or futures contracts. They're demanding physical delivery, and they're taking that gold out of the Western banking system entirely. China's been particularly aggressive. While they report their official gold reserves periodically, analysts who track import data and domestic production believe their actual holdings are significantly higher than what they publicly disclose. They're not just buying gold. They're building a parallel financial system with gold at its foundation. Russia's doing the same thing. India's doing it. Turkey's doing it. Even Poland and Hungary, members of the European Union, are repatriating their gold from foreign vaults and adding to their reserves. Now, you might be thinking, okay, central banks are buying gold. They've always bought gold. What's different this time? Here's what's different: the scale and the urgency. And more importantly, where they're getting this gold from. Remember that COMEX inventory I mentioned? It's not just central banks draining it. Large institutional investors are also taking delivery. In December alone, we saw one of the highest delivery volumes since 2022. Over 25,000 contracts were delivered. Each contract represents 100 ounces of gold. Do the math. That's 2.5 million ounces of gold that had to be physically delivered in a single month, and the COMEX had to scramble to fulfill those deliveries. Now here's where the system failure comes in. The COMEX operates with two categories of gold in their vaults. There's eligible gold, which is gold that meets their standards but isn't necessarily available for delivery. And there's registered gold, which is gold that's specifically allocated for delivery against futures contracts. The registered category has been shrinking dramatically. We're talking about a decline of over 50% in some recent periods. Meanwhile, the number of outstanding futures contracts, the paper claims on that gold, remains enormous. This creates what's called a squeeze. When you have more claims on physical gold than there is physical gold available to deliver, something has to give. Either the price has to rise dramatically to incentivize holders to sell, or the system breaks down because it can't fulfill its delivery obligations. We're watching this play out in real time. And it's not just gold. Silver's experiencing an even more severe version of this dynamic. The COMEX silver vaults saw 60% of their registered inventory claimed in just 4 days recently. 4 days. That's not normal market behavior. That's a run on the bank. Now let me take you back to a similar situation in history because this isn't the first time we've seen this pattern. In 1980, the Hunt brothers tried to corner the silver market. They accumulated massive amounts of physical silver and silver futures contracts. As delivery dates approached, the exchanges changed the rules to prevent a complete system breakdown. They limited trading, increased margin requirements, and essentially rigged the game to prevent the squeeze from playing out. The market crashed, the Hunt brothers went bankrupt, but here's what most people forget. The underlying supply and demand dynamics that made their strategy possible in the first place didn't go away. Silver prices had already risen from around $2 an ounce to $50 an ounce before the intervention. What we're seeing now is different because it's not speculators trying to corner the market. It's central banks and large institutions systematically removing physical gold from the Western financial system. You can't change the rules to stop sovereign nations from taking delivery of their gold. Let me paint you a picture of what this looks like on the ground. Imagine you're a bullion dealer in New York or London. You've been in this business for 30 years. You've seen bull markets and bear markets. You know how the system works. Normally, when a client wants to buy a significant amount of physical gold, you can source it relatively easily. You make some calls, you arrange delivery, it's done within a few days or weeks depending on the quantity. But over the past year, that's changed. Now when you try to source large quantities of physical gold, you're hitting delays. Premiums over spot price are higher, refineries are backed up, shipping times are longer, and most tellingly, some of your usual sources are simply saying they don't have the metal available. This is what a physical shortage looks like in its early stages. It doesn't happen all at once. It's a gradual tightening that accelerates over time until suddenly the system can't function anymore. And here's the critical point. The price you see quoted for gold, the spot price that everyone references, that's primarily determined by paper trading on exchanges like the COMEX. It's not based on physical supply and demand. It's based on the trading of contracts that represent gold, most of which will never result in physical delivery. But when physical demand overwhelms the system's ability to deliver, that paper price becomes disconnected from reality. We start seeing premiums for physical gold over the paper price. We see delays in delivery. We see shortages at retail dealers even while the paper price suggests gold is readily available. This is the system failure. The paper market and the physical market are diverging. And historically, when this happens, the physical market always wins. Always. Because at the end of the day, you can't eat paper. You can't use a futures contract to settle an international trade deal. You can't back your currency with promises. Now, let me connect this to what's happening in the broader economy because none of this is happening in a vacuum. The US dollar just experienced its biggest first-half decline since 1973. Let that sink in. The world's reserve currency, the currency that's been dominant for over 80 years, is weakening at a pace we haven't seen in over 50 years. Why? Multiple factors. Trade policy uncertainty, concerns about US fiscal sustainability, the Federal Reserve's monetary policy decisions. But underlying all of it is a loss of confidence in dollar-denominated assets. When central banks buy gold, they're selling dollars. When they take physical delivery and store it in their own vaults, they're removing themselves from dependence on the dollar-based financial system. This is de-dollarization in action, and it's accelerating. The Federal Reserve is caught in an impossible situation. Inflation remains above their target. The economy is showing signs of weakness. They've cut interest rates, but not aggressively enough to satisfy markets. Meanwhile, the federal government continues to run massive deficits that require constant debt issuance. Who's buying all that debt? Increasingly, not foreign central banks. They're buying gold instead. So the Federal Reserve ends up having to support the bond market, which means creating more dollars, which means more inflation, which means more reasons for central banks to buy gold. It's a self-reinforcing cycle, and we're watching it accelerate. Now, here's something most people don't understand about gold. It's not just a hedge against inflation. It's a hedge against system failure, against the breakdown of trust in financial institutions and government promises. Think about what money actually is. It's a shared belief system. We all agree that these pieces of paper or digital entries in a computer have value because we trust the institutions that issue them. But what happens when that trust erodes? Throughout history, whenever major monetary systems have failed, gold has been the asset that maintains value. Not because gold has any inherent utility beyond jewelry and some industrial applications, but because it's the one asset that exists outside the system. It can't be printed. It can't be created by government decree. Its supply is limited by geology and the economics of mining. When the Roman Empire debased its currency, gold maintained its value. When Weimar Germany experienced hyperinflation, gold maintained its value. When the Bretton Woods system collapsed in 1971, gold's price exploded higher. We're potentially at another one of those inflection points. The post-World War II monetary system, built on dollar dominance and faith in U.S. institutions, is showing cracks. And the smart money is positioning for what comes next. Let me give you some specific numbers to illustrate the scale of what's happening. Gold demand hit a new record in 2024. Total demand exceeded 5,000 tons. That's not just central banks. That's also retail investors, jewelry demand, and industrial use. But here's the key. Mine production is relatively flat. We're not discovering major new gold deposits. The easy gold has already been found and mined. New production is expensive and takes years to bring online, so supply is constrained while demand is surging. This is basic economics. When demand exceeds supply, prices rise. But in the gold market, that price discovery mechanism has been suppressed by the paper market. The ability to create unlimited paper claims on gold has kept prices lower than physical supply and demand would dictate, but that suppression mechanism is breaking down. When physical buyers demand delivery, the paper market can't satisfy them, and that's when prices have to adjust to reality. Now, I want to address something important here. If you're sitting on retirement savings, if you have a significant amount in traditional assets like stocks and bonds, you need to understand how gold fits into a wealth preservation strategy. I'm not saying sell everything and buy gold. That's not smart diversification. But having zero exposure to physical gold in an environment like this is a risk many people don't fully appreciate. Quick aside here. If you have $100,000 or more in retirement accounts, there's a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA. I put together a free guide that explains exactly how it works, what the rules are, and how to evaluate if it makes sense for your situation. You'll find that in the description below. It's worth looking at if you're thinking about adding gold to your retirement strategy. All right, back to what's happening in the market right now. The technical picture for gold is extremely bullish. We've broken through multiple resistance levels that held for years. We're making new all-time highs. And the momentum indicators suggest this move is just getting started. But more important than the technical analysis is the fundamental backdrop. Every major driver is pointing in the same direction. Currency debasement, geopolitical instability, central bank buying, physical shortages, inflation concerns, debt sustainability questions. These aren't short-term factors. These are structural issues that will take years to resolve, if they can be resolved at all. Let me tell you about a conversation I had with a fund manager who's been in the precious metals space for over 40 years. He told me something that stuck with me. He said, "In my entire career, I've never seen a setup like this. The fundamentals have never been stronger. The technical picture has never been clearer. And yet most investors are completely unprepared for what's coming." He's right. Despite gold hitting new highs, despite all the warning signs, most portfolios have minimal or zero gold exposure. The average financial advisor still treats gold as a fringe asset, something for conspiracy theorists and doomsday preppers. But that's changing. Institutional adoption is accelerating. Major pension funds are increasing their gold allocations. Sovereign wealth funds are buying physical metal. Even traditional Wall Street firms that dismissed gold for years are now recommending it to clients. Why? Because they're reading the same data I'm showing you. They're seeing the same structural problems, and they're realizing that the old playbook doesn't work anymore. For decades, the standard advice was 60% stocks, 40% bonds. That portfolio construction assumed that bonds would provide stability and income while stocks provided growth. But what happens when both stocks and bonds are overvalued? When interest rates are manipulated by central banks? When government debt levels are unsustainable? That's the environment we're in now. And in this environment, gold isn't a fringe asset. It's a core holding for wealth preservation. Let me give you another historical parallel. In the 1970s, we had a similar setup. High inflation, currency instability, loss of confidence in government institutions, energy crises, geopolitical tensions. Gold started that decade at $35 an ounce. By 1980, it peaked at over $800. That's more than a 20-fold increase in 10 years. Now, I'm not predicting gold will go up 20 times from here. The starting point is different. The market is larger. The dynamics aren't identical. But the underlying drivers are remarkably similar. And here's what most people forget about that 1970s gold bull market. It didn't go straight up. There were corrections. There were periods where it seemed like the rally was over. But the underlying fundamentals kept pushing prices higher until the system finally broke and gold exploded to its peak. We could be in the early stages of a similar multi-year bull market. The fundamentals are in place. The technical breakout has occurred. The institutional buying is accelerating. And most importantly, the physical market is showing signs of stress that suggest the paper price suppression mechanism is failing. Now, Let's talk about what could derail this thesis. What are the risks to this bullish outlook? The main risk is a genuine strengthening of confidence in the dollar and U.S. institutions. If the Federal Reserve successfully navigates the inflation challenge without causing a recession, if the U.S. government gets its fiscal house in order, if geopolitical tensions ease, if central banks stop buying gold and start selling, then the bull case for gold weakens. But look at the probability of those things happening. Look at the political environment. Look at the debt levels. Look at the structural challenges facing the global economy. The path of least resistance is continued currency debasement, continued loss of confidence, and continued flight to hard assets like gold. Another risk is a major deflationary event. If we get a severe economic contraction, a credit crisis, a stock market crash, there could be a short-term scramble for dollars that pushes gold prices down temporarily. We saw this in 2008. Gold fell from over $1,000 to below $700 as everyone rushed to raise cash. But notice what happened next. Gold recovered quickly and went on to make new highs, eventually reaching $1,900 by 2011. Because the response to that crisis was massive monetary expansion, which validated the gold bull thesis even more strongly. So even if we get a short-term deflationary shock, the policy response will likely be inflationary, which supports gold in the medium to long term. Here's another angle most people miss. Gold isn't just about protecting against worst-case scenarios. It's also about participating in a major bull market. If gold goes from current levels to $3,000, $4,000, $5,000 an ounce over the next several years, that's significant wealth creation, not just wealth preservation. And the risk-reward is asymmetric. If I'm wrong and gold goes nowhere, you've held a stable asset that maintains purchasing power. If I'm right and we're in the early stages of a major bull market, the upside is substantial. Compare that to the risk-reward of being fully invested in stocks at all-time highs with elevated valuations, or bonds yielding below inflation rates. Where's the asymmetric opportunity there? Let me share one more story that illustrates why this matters. I know someone who lived through the hyperinflation in Zimbabwe. He told me about watching his life savings become worthless in a matter of months. He had money in the bank. He had a good job. He thought he was financially secure. But when the currency collapsed, none of that mattered. The money in his bank account couldn't buy groceries. His salary was worthless by the time he received it. Everything he'd worked for disappeared. The only people who preserved their wealth were those who had converted their savings into hard assets before the collapse: gold, silver, real estate, anything tangible that couldn't be inflated away. Now, I'm not saying the US dollar is going to experience Zimbabwe-style hyperinflation. That's an extreme scenario. But the principle is the same. When confidence in a currency erodes, when the system shows signs of failure, having some of your wealth in assets that exist outside that system is essential. And right now we're seeing those warning signs. The COMEX inventory drain, the central bank buying, the dollar weakness, the fiscal deficits, the monetary policy mistakes. These are all flashing red lights that something is wrong with the current system. The smart money is paying attention. They're positioning for what comes next. And what comes next is likely a repricing of gold to reflect its true value in a world where trust in fiat currencies is declining. Think about what gold is trading at right now relative to the money supply. In 1980, when gold peaked at $800, the U.S. money supply was a fraction of what it is today. If you adjust gold's 1980 peak for the expansion in the money supply since then, gold should be trading well above its current price. Some estimates put the inflation-adjusted equivalent at over $3,000. That's not a prediction. That's just math. It shows you how undervalued gold is relative to the amount of currency that's been created. And here's the thing. That currency creation isn't stopping. It can't stop. The system is built on continuous expansion of credit and money supply. The moment that stops, the whole structure collapses. So the only path forward is more inflation, more currency debasement, and higher gold prices. This is why central banks are buying. They understand the end game. They're preparing for a world where gold plays a more prominent role in the international monetary system. Whether that's a formal return to some kind of gold standard, or just an informal recognition that gold is the ultimate reserve asset, the direction is clear. Now, let me address the elephant in the room. Why isn't everyone talking about this? If the situation is as serious as I'm describing, why isn't it front-page news? There are a few reasons. First, the mainstream financial media is largely focused on stocks. That's where the advertising dollars are. That's what most people are invested in. Gold is a niche topic that doesn't generate the same level of interest or revenue. Second, there's a vested interest in maintaining confidence in the current system. Central banks, governments, major financial institutions, they all benefit from the status quo. Talking about system failure and the need for gold is not in their interest. Third, most people don't understand the gold market. They don't know about COMEX inventory levels or the difference between paper and physical gold. They see the price going up and assume it's just another speculative bubble. But the people who do understand what's happening, the people who manage billions of dollars, the people who have access to the best research and analysis, they're buying. Quietly, systematically, without fanfare, and that's your signal. When the smart money is accumulating an asset while the general public is ignoring it, that's when the best opportunities exist. So, what should you do with this information? First, educate yourself. Understand how gold fits into a diversified portfolio. Understand the difference between physical gold and paper gold. Understand the risks and the potential rewards. Second, consider your personal situation. How much of your wealth is in assets that depend on the current system functioning properly? How much do you have in assets that would maintain value if that system fails? Third, take action appropriate to your circumstances. That might mean buying some physical gold coins or bars. It might mean adding gold mining stocks to your portfolio. It might mean exploring a gold IRA if you have significant retirement savings. Whatever makes sense for your situation. But don't ignore what's happening. Don't assume that because the system has worked for your entire lifetime, it will continue to work forever. History shows us that monetary systems fail, currencies collapse, and when they do, the people who prepared are the ones who preserve their wealth. The system failure alert that gold is flashing right now is real. The COMEX inventory drain is real. The central bank buying is real. The dollar weakness is real. These aren't conspiracy theories or fear-mongering. These are facts that you can verify yourself. And the implications are profound. We're potentially at the beginning of a major repricing of gold relative to fiat currencies. A repricing that could take years to fully play out. A repricing that could create significant wealth for those positioned correctly and significant losses for those who ignore the warning signs. The choice is yours. You can dismiss this as just another gold bug prediction. You can assume that the system will muddle through like it always has. Or you can look at the evidence objectively and make informed decisions about protecting and growing your wealth. But understand this. The window for positioning before the crowd realizes what's happening is closing. Once this becomes mainstream knowledge, once the physical shortages become undeniable, once the price starts moving in earnest, it will be too late to get in at favorable levels. The smart money is acting now. They're not waiting for confirmation. They're not waiting for the mainstream media to tell them it's safe. They're looking at the fundamentals, recognizing the opportunity, and taking action. That's what I'm encouraging you to do. Look at the evidence, understand what's happening, and make decisions that protect your financial future. Because the system failure that gold is warning us about isn't a maybe, it's a when. And being prepared for that when is the difference between preserving your wealth and watching it evaporate.